So imagine generating $10 billion in a single quarter.
Right.
Like a staggering 50% growth rate.
Yeah, which is huge.
And Wall Street's immediate reaction is just to completely panic about your shrinking profits.
It makes no sense, but
It's wild. So today we're looking under the hood of Latin America's e-commerce and fintech juggernaut, MercadoLibre. We want to figure out why management is, actively choosing to make less money right now.
yeah, intentionally.
Yeah, right. So welcome to another Talk Tickers deep dive, where we strip away all the dense financial jargon from corporate earnings calls, figure out what the data is actually telling us, and give you a concise, actionable verdict.
It really is the perfect paradox for us to dissect today, because we're digging into MercadoLibre's Q2 2026 earnings call, ticker symbol MELI, and the tension on this call is just palpable.
Oh, you could feel it.
You really could. You have the CEO, Ariel Scharstein, and the CFO, Martín de los Santos, basically defending a quarter that, well, if you only look at the surface level margins, it sends a total wave of anxiety through retail investors.
Right. The retail guys are freaking out.
Exactly.
Yeah.
But the underlying mechanics tell a completely different story.
And that's exactly what we need to unpack here. Because the headline numbers are, they're nothing short of massive.
Yeah.
We're talking about a company operating across Brazil, Mexico, Argentina, and they're completely rewiring how an entire continent shops and banks.
Entirely.
So let's start with that blockbuster top line. $10 billion in net revenue.
For a single quarter.
A single quarter, yeah.
It's the first time in the company's history they've crossed that $10 billion threshold.
Wow.
And what makes that figure so compelling isn't just the absolute size of it, but the velocity,
Right, how fast they got there.
Yeah, to maintain a 50% year-over-year growth rate at that sheer scale is just extraordinary.
It's almost unheard of.
It really is. It indicates that the fundamental consumer demand across Latin America for their marketplace and their digital services, it isn't just holding steady, it's actually accelerating.
Accelerating, right. And it's crucial to understand that they aren't just selling like smartphones and sneakers anymore.
No, not at all.
The other massive figure that jumped out of this transcript is the credit boom.
Oh, yeah.
Their credit portfolio exploded to $16.4 billion.
Which is just a crazy number.
It is. That's up 75% year over year.
Yeah, the credit side of the business, so Mercado Pago and the consumer and merchant loans they issue is actually growing substantially faster than the core e-commerce side now.
Really?
Yeah, they're lending out billions and they're scaling that operation aggressively, specifically targeting Brazil and Mexico.
Okay.
Because they're basically stepping into this massive void left by traditional Latin American banks.
Oh, right, because those banks have historically kind of ignored those people.
Exactly. They've chronically underserved the middle and lower income demographics. So MercadoLibre is just swooping in.
Okay, but here's where I have to pause and put on my skeptical retail investor hat.
Good.
Because that is exactly what the Wall Street analysts zeroed in on during the call.
Oh, they definitely did.
Revenue is up 50%, credit is up 75%, but then you look at the profit margins and the alarm bells just start ringing.
Right. So the income from operations sat at $683 million, which yields an EBIT margin, so earnings before interest and taxes, of just 6.7%.
And a 6.7% margin, that represents a drop of 550 basis points from the same time last year.
Yep.
Which, let's translate that into plain English, that's a 5.5% drop.
Yep.
So for every $100 MercadoLibre made this quarter, they kept $5.50 less in operating profit than they did a year ago.
Correct.
If I'm holding this stock, seeing margins shrink that fast is terrifying. Are they just buying revenue at the expense of profitability?
It looks like it, right?
Yeah. Are we looking at a fundamentally flawed business model here?
Well, it's the natural question to ask, and the analysts from Goldman Sachs pushed them really hard on it.
I bet.
But what's truly fascinating about this transcript is that management isn't scrambling to apologize for the margin compression at all.
No.
Not even a little. They're explicitly stating that this is a highly deliberate choice.
Wait, deliberate?
Yes. They generated $214 million in adjusted free cash flow this quarter alone.
Okay.
And instead of letting that drop to the bottom line to make the quarterly profit look pretty for Wall Street, they're plowing it directly back into market dominance.
A deliberate choice to make less money. That sounds great in a corporate press release,
Right, sure.
But I want to know where exactly that money is going. What are they buying with that $5.5 5% of margin they just surrendered.
Okay, well, the CFO broke it down into very specific strategic investments and operational absorptions.
Okay.
So let's start with Brazil. They made a strategic decision to heavily subsidize promotional discounts for consumers who pay using Pix.
Pix being the instant payment system created by Brazil's central bank, right?
Correct. And Pix has completely revolutionized payments in Brazil. I mean, practically overnight.
Yeah, everybody uses it.
Exactly. So MercadoLibre is actively lowering their own take rates, meaning they're willingly taking a smaller cut of the transaction just to encourage more merchants to join their platform and accept these Pix payments through Mercado Pago.
Oh, I see. So they are sacrificing immediate transaction revenue to build up raw volume.
Exactly.
Just trying to habituate people to using their system over anything else.
Precisely. And now combine that with what's happening in their acquiring business.
Okay, what do you mean by acquiring business?
This refers to the physical point-of-sale machines. You know, those little blue card readers you see at coffee shops and street vendors all over Latin America?
Oh, yeah, they're everywhere.
Right. So MercadoLibre is facing higher supply chain costs for the microchips that go into those physical devices.
Because of the global chip stuff.
Right. And normally, a company would just raise the price of the machine to protect their margin.
Yeah, pass the cost on to the consumer. That's standard practice.
But they didn't. They absorbed the hit entirely.
Wait, really?
Yeah. Why? Because their competitors in the space aren't raising prices either.
Ah, so it's a price war.
Kind of. MercadoLibre looked at the board and realized that keeping the price of the device artificially low allows them to deploy thousands of these machines a day.
Wow.
And that captures massive market share in the physical retail space.
Okay, that makes sense. And I noticed they had a similar situation in Mexico with an inventory restock, which also dragged down the margin, right?
Yes, exactly. Their Mexican operation is growing so incredibly fast that they had to buy a massive new stock of those point-of-sale devices just to meet merchant demand.
Good problem to have.
Definitely. But under accounting rules, because they sell the devices at a loss to acquire the merchant, they have to book that financial loss up front, like the exact moment they increase the inventory.
Ah, so it hits the quarterly margin immediately.
Yep.
Making the balance sheet look worse today, even though those physical devices are going to sit on merchant counters generating highly profitable transaction fees for, the next 5 years?
Exactly. They're trading fractions of a percent today to fundamentally capture the merchant ecosystem for the next decade.
That's fascinating.
And that transitions us perfectly into the core philosophy driving all of this spending. Throughout the call, the CEO and CFO kept utilizing a very specific phrase to describe what they are building.
What was it?
They called it the ecosystemic user.
Ecosystemic user.
Okay.
It sounds highly clinical, but I assume they just mean a customer who is totally locked into their platform.
Basically, yeah. It's a customer who utilizes both halves of the MercadoLibre empire. So they shop for physical goods on the e-commerce marketplace. And they also use the Mercado Pago Fintech app for their banking, their digital payments, or their credit lines.
So someone buys a new television on the marketplace, but they finance it using a Mercado Pago credit card.
Exactly.
So they are interacting with the retail side and the financial side simultaneously.
That is the exact profile.
Yeah.
And the data they shared on these specific ecosystemic users reveals why they are willing to sacrifice so much margin to acquire them.
Okay, lay the data on me.
Well, an ecosystemic user generates 70% more gross merchandise volume, meaning they spend 70% more on physical goods than a standard shopper.
Wow. 70%?
Yeah. And on the fintech side, they generate 90% more total payment volume.
90% more.
Yeah, it's massive.
So moving someone from a single app user to a dual app user doesn't just result in a marginal bump in sales.
No, not at all.
These users become exponentially more valuable. It's like establishing a massive gravitational pull, you know? You bring them in with a localized, convenient shopping experience, you hand them a digital wallet to pay for it, and suddenly you are their entire financial and retail universe.
Gravitational pull is the perfect metaphor. You're creating a walled garden where money never actually has to leave the ecosystem.
Right, it just circulates.
Exactly. The CFO explicitly stated that the contribution profit from one ecosystemic user is multiples higher than a user who only exists on one side of the platform.
Okay, that clarifies the margin drop a lot.
Right, and we saw concrete proof of how they are engineering this behavior in the Brazil data. They spent a significant portion of the call reviewing a decision they made 12 months ago to lower the free shipping threshold in Brazil.
Which means making it cheaper and easier for a customer to qualify for free delivery on an order.
Yep.
Which, again, hits the profit margin because the company is eating the shipping cost.
Exactly. And conventional e-commerce wisdom might dictate that if you lower the shipping threshold, you're just going to attract a bunch of low-value buyers purchasing cheap knickknacks.
Yeah, people buying $3 phone cases.
Right. And then the logistical costs will just eat you alive.
Sure.
But that is not how the consumer psychology played out here.
Right. The metrics they reported were phenomenal. Items per buyer grew 19% year over year.
19%.
And conversion rates, the actual percentage of people who open the app and complete a purchase jumped by 1.1 percentage points.
Yeah.
Which, for anyone who doesn't work in digital retail, a 1.1% jump in conversion at a multi-billion-dollar scale is a seismic shift.
It is massive.
Yeah.
But here is the most critical insight management shared about that data. The new cohorts of buyers that joined the platform after they lowered the shipping threshold are actually retaining at higher rates.
Slightly.
Yeah, and they're buying more frequently across entirely new categories than the older cohorts.
Wow, so it wasn't just a marketing trick to temporarily boost the audience size. It permanently changed consumer behavior.
Exactly. As they noted on the call, daily active users are now growing faster than monthly active users.
Meaning people are opening the MercadoLibre app every single day just to see what's there.
Yeah, much like they would open a social media app.
Right. They aren't just logging in once a month because they need to buy a specific replacement part for their car.
Right.
But, to handle millions of people casually browsing and interacting with your app daily requires a staggeringly complex back-end infrastructure.
Oh, absolutely.
Which leads us into what was undoubtedly the most fascinating revelation of the entire transcript for me.
Oh, the AI stuff?
Yes, their investment in artificial intelligence.
It was a massive capital allocation. Management casually dropped that they spent $80 million directly on AI this quarter alone.
Just casually, $80 million bucks.
Yeah. That is a significant jump from a year ago. But when the analysts probed them on this, trying to figure out if this was just a trendy tech expense management, aggressively framed it as an absolute accelerator for the underlying business mechanics.
I want to break down exactly how that $80 million is generating a return on investment.
Let's do it.
Because AI is like the biggest buzzword on Wall Street right now.
Oh, for sure.
And half the companies claiming to use it are just slapping a chatbot on their homepage and calling it a day.
Yeah. Totally.
So how is MercadoLibre actually deploying this?
Well, they gave incredibly concrete operational examples. Let's look at the consumer-facing side first.
Okay.
They deployed a new AI architecture to their core search engine across their 5 largest national markets.
Okay.
Now, running AI models at that scale is expensive because you are paying compute costs for every single search query.
Right. All those tokens add up.
Exactly. However, the incremental volume of items sold, because the search results were vastly more accurate, combined with those higher conversion rates we talked about, completely covered the computational cost.
Wow.
It's already cash flow positive.
That's incredible. And they also highlighted an internal tool they built called the Ad Orchestrator.
Yes.
This is essentially an AI engine designed to figure out exactly which advertisements to show to which shoppers at the precise moment of intent. And the usage of that internal tool grew 66% this quarter. And it was the primary driver pushing their overall advertising revenue up 73% year over year.
Yeah, that ad revenue is basically pure profit too.
Right.
But where the AI investment shifts from impressive to industry altering is in their internal productivity gains.
Right.
4 years ago, MercadoLibre employed 10,000 customer service representatives just to handle disputes, returns, and merchant issues.
10,000?
Today, they only employ 7,000.
Wait, let me make sure I'm grasping the scale of that. Their human headcount in customer service went down by 30%, but their total business volume has roughly tripled in that same 4-year window.
Precisely.
How is that even possible?
Because 90% of their customer interactions are now resolved entirely without a human participating.
90%.
Yeah. The AI agents are handling the entire life cycle of the ticket.
How does that actually work in practice, though? Because I think a lot of people hear AI customer service, and they just imagine the frustrating, loop-driven phone menus of the early 2000s.
Oh, I know.
Like, press 1 for returns, and it never understands what you say.
Right, but it's fundamentally different now. When a buyer initiates a return, the AI instantly analyzes the buyer's historical reputation score, the seller's rating, the category of the item, and the logistical tracking data.
It just pulls all that at once.
In milliseconds. And it cross-references all of that against their fraud models. If it determines the return is legitimate and low risk, the AI authorizes the refund to the Mercado Pago wallet, generates the return shipping label, and closes the ticket before a human agent would have even opened the email.
That level of operational leverage is just astounding.
It really is.
But, the detail in the transcript that actually made my jaw drop was regarding their software engineering department.
Oh, yeah, the coding.
Yeah, they employ 20,000 developers.
20,000.
And on a previous earnings call, they mentioned that developers were being assisted by AI tools.
Right, like Copilot stuff.
Yeah, exactly. But this quarter, the CFO stated, and I want to quote this directly, "Human written code is an exception. The majority of the code is done by AI."
It is a staggering operational reality.
It's insane.
For the first time in their modern history, MercadoLibre is actively choosing not to grow its engineering headcount.
They're freezing it.
They froze it at 20,000, entirely because AI is driving developer productivity to such unprecedented heights.
Wow.
They're scaling a global technology infrastructure without having to scale the human workforce proportionally.
And that flows directly back to the bottom line, offsetting some of those aggressive market share investments we talked about earlier.
Exactly.
Because they noted that product development costs actually dropped from 8.4% of revenue down to 7.2% of revenue, even when you include that massive $80 million AI bill.
It's the purest definition of doing more with less.
Absolutely. And this immense operational efficiency running quietly in the background is precisely what gives management the confidence to be so aggressive on the front line.
Yeah, it funds the war chest.
Exactly. Which brings us to part 3, the forward-looking guidance and how they view their competitive moat.
Right.
Let's talk about those front lines, specifically their credit card issuance.
Okay.
Because management made it very clear that putting plastic or a digital equivalent in someone's hand is the ultimate weapon for capturing the Latin American consumer.
They are accelerating that rollout intensely.
Tell me about it.
In Brazil alone, they issued 2.6 million new credit cards this quarter.
2.6 million.
Yeah, and to put that in perspective, a year ago, they were only issuing 1.6 million.
So they're aggressively ramping up distribution. But earlier you explained that issuing credit hits their short-term margins. How does that math work?
Right, so it does drag on the immediate margins. Because when you issue a new credit card, there are upfront customer acquisition costs, manufacturing and shipping costs for the physical cards, and most importantly, you have to provision capital for potential early defaults.
Ah, right, the accounting reserve.
Exactly. All of that hits the income statement immediately. But Oswaldo Jimenez, the president of Fintech, walked the analysts through the life cycle of these cards.
What did he say?
He explained that these new cohorts typically break even in 12 to 18 months.
Okay.
After that point, the upfront costs are amortized, and they become massive recurring profit engines.
And it all ties directly back to that gravitational pull we discussed.
Yep.
Management explicitly stated that issuing a credit card is the single biggest catalyst for turning a standard user into an ecosystemic user.
It flips the switch.
A customer gets the card, their net promoter score, which measures customer satisfaction spikes, and suddenly they transition from just buying shoes once a month to making Mercado Pago their primary daily bank.
But aggressively issuing millions of credit cards in emerging markets raises a massive flashing red flag for traditional financial analysts.
Oh, I'm sure.
And the analyst from UBS asked the exact question we are all thinking. Asset quality.
Yes.
If you're issuing 2.6 million credit cards in a single quarter in an environment where inflation and interest rates can be highly volatile, aren't you taking on an existential level of default risk?
Exactly. What happens to the balance sheet if the macroeconomic cycle turns sour?
Right.
Because nobody wants to be left holding the bag on millions of bad consumer loans. How did management defend their underwriting standards? Like, what did they report regarding non-performing loans or NPLs?
This was where MercadoLibre's 27 years of proprietary consumer data really shone through.
Okay.
They reassured the market that their NPLs are actually sitting at near historic lows.
Really?
Yeah. For their total credit portfolio, the 15 to 90-day NPL rate was 7.0%. But for the credit cards specifically, which they reserve exclusively for their lower risk proving users, The NPL rate was just 4.6%.
4.6%. Okay, so they aren't just blanket approving everyone who downloads the app.
No, definitely not.
They're leveraging their e-commerce data, knowing exactly what a user buys, how often they buy, their return history, to cherry pick the absolute best credit risks from their marketplace.
Precisely. But the most impressive part of that exchange was how management educated the Wall Street analysts on how traditional banking metrics can misrepresent a modern fintech portfolio.
Oh, this was a masterclass in financial mechanics.
It really was.
Break down exactly how that mathematical distortion works, because it's fascinating.
So one analyst pointed out that while short-term default rates looked fantastic, the longer-term NPL rates showed a slight deterioration.
Like it was ticking up slowly over time.
Right. But the CFO stepped in and meticulously explained the mathematical distortion happening beneath the surface.
It's because it has to do with the duration of the loans?
Right. Exactly. MercadoLibre offers a lot of very short-term credit products, sometimes just a few weeks or months to finance a specific purchase.
Okay.
When a good borrower pays off that short-term loan quickly and responsibly, they exit the active loan portfolio.
Because the debt is settled.
Right. But the defaulters, the people who don't pay,
They stay in.
yes, they remain stuck in the non-performing portfolio for up to 360 days before the debt is fully written off.
Ah, I see it. Because the reliable payers are clearing their debts quickly and leaving the denominator of the equation, the bad loans that stick around make the overall percentage of defaults look artificially higher over time.
Exactly. It's a mathematical illusion caused by the speed at which their good customers revolve their credit.
Wow.
It is not a fundamental deterioration in their underwriting quality. They're utilizing their AI risk models to manage this massive credit expansion beautifully.
That is so smart. But to be fair, the earnings call wasn't entirely a victory lap.
No, it wasn't.
Management was transparent about navigating some very real systemic headwinds, particularly in Mexico.
Yes, the analysts from FT Partners pressed them on this. Mexico has been an explosive growth engine for MercadoLibre, but they are currently facing a newly implemented government tax reform that is acting as a significant friction point for e-commerce.
What exactly does that tax reform entail, and how does it hurt their bottom line?
Well, without getting bogged down in international tax law, the Mexican government essentially implemented new withholding tax requirements for third-party sellers on digital marketplaces.
Okay, so MercadoLibre has to play tax collector.
Basically, yeah. This forces MercadoLibre to withhold a portion of the seller's revenue up front for tax purposes.
Oh, I see.
For smaller merchants operating on thin margins, this can drastically reduce their available working capital.
Right, because they don't have the cash flow.
Exactly, making it harder for them to restock inventory and grow their sales on the platform.
So it suppresses the overall volume of goods flowing through the Mexican marketplace. And combine that regulatory hurdle with a generally softer macroeconomic environment in Mexico right now, plus the fact that consumer spending temporarily dipped because everyone was glued to the World Cup.
Oh yeah, the World Cup dip is real.
Right. And you have a recipe for some serious near-term pressure.
It is a very real headwind. But what's critical for investors to note is that even with those localized pressures, MercadoLibre is still gaining market share in Mexico faster than Amazon or their local competitors.
Yes. Oh.
Furthermore, they're aggressively offsetting any domestic weakness by supercharging their cross-border trade, or CBT.
Let's dig into that cross-border trade, because the numbers they revealed here were staggering.
Yeah.
Their overall CBT gross merchandise volume is growing at 60% year over year.
60%.
But the truly explosive statistic was regarding their fulfillment center in China. Volume coming out of that specific Chinese warehouse is up 170% quarter over quarter.
170% growth in 3 months.
How are they even doing that?
Yeah. What they are doing here is brilliantly strategic. They aren't just letting Chinese merchants list items on their website and hoping the international shipping works out.
Like a standard drop shipping model.
Right. MercadoLibre actually set up their own consolidation warehouses directly in tech and manufacturing hubs like Shenzhen and Guangzhou.
So they're aggressively bridging the gap between Chinese manufacturing and the Latin American consumer.
Yep.
How does controlling that warehouse in China fundamentally change the economics of the transaction? Like, why bother?
It solves the biggest problem in cross-border e-commerce: delivery anxiety.
Okay, sure.
Historically, if a buyer in Bogota or São Paulo ordered a cheap gadget directly from a Chinese seller, they would wait 4 to 6 weeks for it to arrive.
Assuming it didn't get lost in customs.
Exactly. And that massive delay leads to incredibly high order cancellation rates and terrible customer satisfaction.
Right. But by operating the warehouse themselves, MercadoLibre controls the logistics from end to end.
Exactly. A Chinese merchant drops a massive pallet of goods at the MercadoLibre warehouse in Shenzhen.
Okay.
MercadoLibre software catalogs it, loads it onto a chartered flight to Mexico or Brazil, clears it through customs in bulk using their established regulatory relationships, and injects it directly into their own last-mile delivery network.
Wow.
They're reducing a chaotic 4-week wait down to a predictable handful of days.
And radically faster delivery times mean fewer canceled orders.
Yeah.
Fewer cancellations mean the Chinese merchants get paid faster and see higher returns, which makes MercadoLibre a vastly more attractive platform for them than a competitor like AliExpress or Shein.
It creates a completely self-reinforcing logistical loop.
It is a masterstroke in supply chain management, and it's exactly the kind of deep structural moat that requires years of investment and billions of dollars to build.
Absolutely.
Which brings us to part 4, the ultimate question of this Talk Tickers deep dive.
The bottom line.
We've translated the financial jargon, we've explored the explosive credit growth, the AI efficiencies, and the supply chain mechanics. So what's the bottom line for the retail investor listening right now? Where do we stand on MEALI?
My verdict is decidedly bullish. Intensely bullish.
Even factoring in that 5.5% drop in profit margins.
Especially because of it.
Really?
Yeah. If there's one takeaway from this entire transcript, it's this. Do not let that short-term margin compression scare you out of a generational growth story.
Okay.
When you analyze the mechanics of what management is actually doing, this was a textbook quarter for moat building. MercadoLibre is deliberately and strategically trading a few basis points of profit today to lock in lifelong ecosystemic customers tomorrow.
So the actionable advice here is clear.
Very clear.
If you're currently holding the stock, this transcript is a massive signal to hold strong and trust the executive team's long-term vision. They aren't just operating a digital storefront. They are paving the digital roads, constructing the banking infrastructure, and establishing the logistical pipelines for an entire continent.
Exactly. And if you're on the sidelines considering a position, the current market anxiety over that short-term margin drop might actually present a compelling long-term entry point.
A buying opportunity.
Yeah. Their strategy of actively suppressing immediate profits to aggressively issue credit cards, lower shipping barriers, and subsidize instant payments is working flawlessly to capture and digitize the broader Latin American economy.
They're building the infrastructure of the future today. And that brings me to a final thought I want to leave everyone with to mull over.
Okay.
It goes back to that shocking detail about their software engineering.
The AI code generation.
Yes. MercadoLibre casually mentioned that the majority of their software code is now being written by artificial intelligence.
It's still hard to wrap my head around.
Right. That technological leap is allowing them to literally freeze their engineering headcount at 20,000 people, even as their business volume scales by 50%.
It's a complete paradigm shift for corporate operations.
It really is. We always talk about tech companies being defined by armies of highly paid developers typing away in Silicon Valley or, globally distributed teams.
Right.
But if a $60 billion e-commerce giant is essentially letting AI build and scale its core digital infrastructure today in 2026, what exactly does a tech company look like in 5 years?
It's a great question.
Will the standard 20,000 person developer team simply cease to exist, replaced by a handful of AI orchestrators?
It's very possible.
It's a fascinating and slightly terrifying glimpse into the future of corporate labor. Think about that as you look at your portfolios this week. Until next time, keep diving deep.